Hello viewers, welcome to my channel. I'm Hasham Ali Khan. Last video 4 problems I have completed on problems on AS 2, 3, 4, 5, 7 and 9. On these accounting standards, 4 problems I have completed in the last video. In this video, I'm continuing the problem particularly on AS2, that is valuation of inventories. So on this accounting concept, few more problems I'm going to solve. So before starting the next problem, that is problem number 5, I expect my viewers to have a printout of the problems which I have given in the link under my description. Keep ready the problems. Take the screenshot of the solutions of the problem 5, 6, 7, 8. Then I'll continue. If you have not watched the earlier video, go to the playlist of my channel. Select the subject Accounting Standards. Watch the video on problems on accounting standards. Be perfect. Then you come to this video. Take the screenshot of the points which are written on the board. Then I'll explain all the points in detail. Now, see the problem number 5. Fifth problem I am reading out. Sony Pharmacy ordered 12,000 kilogram of certain material at rupees 80 per unit. So this company Sony Pharmacy is wants to purchase 12,000 kilogram of certain material at 80 rupees per unit. The purchase price includes excise duty of rupees 4 per kilogram, in respect of which full CENVAT credit is admissible. Actually, CENVAT is the central value added tax. So this purchase price includes the CENVAT tax and it is admissible. That means later on they will get the deduction. So what we have to do is this CENVAT credit should be deducted from the purchase price, because whatever CENVAT we are paying, that will be recovered when we sell the goods. Now, freight incurred amounted to 77,400. This freight will be added to the cost of material. Normal transit loss is 3%. So whatever quantity we purchase, 3% will be lost in the transit. So 12,000 kilogram we are purchasing. So 3% of 12,000 will be normally lost. The company actually received 11,600 kilogram and consumed 10,100 kilogram of material. That means remaining material is in closing stock, not sold. Compute the cost of inventory under AS2 and abnormal loss. So two things it is asking. First of all, what is the value of the closing inventory? Secondly, what is the value of abnormal loss? We'll calculate one by one. First of all, what is the purchase price per kilogram? 80 rupees per kilogram. That is the purchase price. How many kilogram we are purchasing? 12,000 kilogram. So first of all, computation of cost of inventory, purchase price of material, 12,000 kilogram purchased, each kilogram 80 rupees. So it comes to 9,60,000. From this, we deduct the CENVAT credit. CENVAT credit 12,000 kilogram into 4 rupees. That is given in the problem. So 12,000 into 4, 48,000 will be deducted from the purchase price. Because this CENVAT is included in this 9,60,000. But we are going to get back this because it is admissible. So deduct 9,12,000. To this we add freight charges. The freight charges are given 77,400, add up. The total cost of the material comes to 9,89,400. This is the total cost of the material. Now, normal loss, it is given in the problem that loss in transit is 3%. So we are purchasing 12,000 kilogram, but all 12,000 kilogram we can't receive during the transit. On the way, 3% will be lost, normal loss. So 3% of 12,000, it comes to 360 kilogram will be normally lost. The normal, quantity to be received is how much? Net quantity after normal loss, So 12,000 minus 360, we should get 11,640. 11,640 is the normal quantity to be received. So when we purchase 12,000 kilogram, we are receiving the net quantity 11,640 kilogram after normal loss. Now we can easily calculate what is the cost of material per kilogram. What is the total cost of material? 9,89,400. How much net quantity we have received? 11,640. So divide it. Per kilogram cost is 9,89,400 divided by 11,640 kilogram. You will get 85 rupees cost per kilogram. 9,89,400 divided by 11,640. 85 rupees per kilogram. But how many kilograms is the abnormal loss? Actually, we should receive 11,640. But in the problem it is given that net quantity received is 11,600 only. It is given in the problem. The company actually received 11,600 kilogram. Actually, it should have received 11,640. So there is a 40 kilogram abnormal loss. So abnormal loss quantity 11,640 minus 11,600, 40 kilogram. Now it is asking you what is the value of abnormal loss. The value of abnormal loss, 40 kilogram is the abnormal loss into what is the cost per kilogram? 85 rupees. 40 into 85, it comes to 3,400. So 3,400 is the value of abnormal loss. Now it is asking you what is the value of closing inventory. Actually, the actual quantity received is 11,600, but consumed is 10,100. So 11,600 minus 10,100, you will get 1,500 kilogram that is remaining unsold. So closing inventory is 1,500 kilogram and each kilogram the cost is 85 rupees. So 1,500 into 85, you will get 1,27,500. This is the value of closing inventory. That's it. So this is the end of problem number 5. Now, 6th problem. In a production process, normal waste is 5% of input and 5,000 MT, MT stands for metric tons. So 5,000 MT of input were put in the process, resulting in a wastage of 300 MT. So actually normal loss is 5%. During processing, 5% of the input will be lost. So 5,000 MT was the input. So out of 5,000, 5%. So 5% of 5,000, it comes to 250 MT. The normal wastage should be 250 MT. But the actual wastage is given, the process resulting in a wastage of 300 MT. So instead of 250 MT, the actual loss is 300 MT. That means 50 MT is the abnormal wastage. 50 MT is the abnormal wastage. Now cost per MT of input is 1,000, rupees 1,000. The entire quantity of waste is on stock at the year end. The entire stock of wastage. So wastage, total wastage is 300 MT. Total wastage is 300 and the entire wastage was included in the closing inventory. State with reference to accounting standard how much will you value the inventory in this case. How much you will include in the closing inventory according to AS2. That's what. Now I have clearly written down here, see carefully. Total input 5,000 MT, that is the total input of the material, and total wastage 300 MT given. But normal wastage is 5%. So 5% of 5,000, it comes to 250 MT. The normal wastage should be 250, but the actual wastage is 300. So abnormal wastage is 300 minus 250, you will get 50 MT. That is abnormal wastage. Now, what is the provision under AS2? In paragraph 13 of AS2 requires that abnormal amount of waste material, labor and other production cost should not be included, should be excluded from the cost of inventory. Specifically given in AS2. That means the value of abnormal wastage, that is material cost, labor cost or any other production cost on abnormal wastage should be excluded from the value of the inventory. So this 50 MT abnormal wastage, the value of this 50 MT abnormal wastage should not be included in the value of the inventory. That is the provision given under para 13 AS2. Thus the cost of 250 MT should be included. The normal wastage, the cost of normal wastage should be included. The normal wastage, how many MT? 250 MT. So we calculate 250 MT value that will be included in the closing inventory. So thus the cost of 250 MT should be included in the cost of inventories at the year end. Now what will happen to the value of abnormal wastage 50 MT? 50 MT is the abnormal wastage. What is the cost per MT? It is given in the problem 1000 rupees. So 1000 into 50, it comes to 50,000. So rupees 50,000 is the value of abnormal wastage, and this 50,000 abnormal wastage should not be included in the closing inventory. It's an abnormal loss, so it should be charged to profit and loss account or income statement. So the entire cost of abnormal waste rupees 50,000, that is being 50 MT at the rate of 1000 per MT, should be charged to profit and loss account. Simply, this is the provision of AS2. Next, seventh problem. X company limited purchased goods at a cost of rupees 40 lakhs in October 2005. Till March 2006, 75% of the stock were sold. So this company has purchased goods worth rupees 40 lakh in October 2005. By the end of March 2006, when the company closes the books, at that time 75% of the goods were sold, only 25% is remaining. The company wants to disclose closing stock at rupees 10 lakh. How this 10 lakh comes? 25% of 40 lakh. So 40 into 25%, you will get 10 lakhs. So 10 lakh worth of goods are remaining. The expected sale value is 11 lakh rupees and a commission at 10% on sale is payable to the agent. Then advise what is the correct closing stock to be disclosed as of 31st March 2006. So according to AS2, what should be the value of the closing stock at the end of the year, 31st March 2006? This is the question. Already in the beginning I told you, when I have explained about AS2, the provisions regarding value of inventory is, inventory should be valued at a lower of cost or net realizable value, whichever is less. Here the cost is 10 lakh rupees, but the net realizable value means the market value minus selling expenses. So here it is given the market value is 11 lakh, but the company has to pay 10% as commission to the agent. These are the selling expenses. The 11 lakh into 10%, 1,10,000. The company has to pay commission 1,10,000 to get the sale of 11 lakh rupees. So net realizable value is 11 lakh minus 1,10,000. You will get 9,90,000. The net realizable value 9,90,000, whereas cost is 10 lakh rupees. Whichever is lower, that should be taken as the value of closing inventory according to AS2. Now here, according to AS2 on valuation of inventories, inventories are to be valued at lower of cost or net realizable value, NRV. Simply remember, the cost or NRV, whichever is lower, that should be taken as the value of inventory according to AS2. In the present case, the cost of the remaining 25% of stock is 10 lakh. That is 25% of 40 lakh. The company has purchased total goods 40 lakh, out of which 75% sold out, 25% remaining. So 10 lakh rupees is the cost. Now let us compute the NRV, net realizable value. So NRV is the estimated selling price in the ordinary course of business less the estimated cost necessary to make the sale. Here definition I have given. What do you mean by NRV? NRV is the estimated selling price. Estimated selling price less the cost incurred to make the sale. The cost to be incurred to make the sale. So here the stock has an expected sale value of rupees 11 lakh, that is given in the problem. However, a commission of 10% on sale is payable to the agent. So 10% of 11 lakh, it comes to 1 lakh 10,000. Thus, in order to realize the sales value of 11 lakh, 1 lakh 10,000 need to be given as commission to the agent. Hence, NRV would be 9 lakh 90,000. How 9 lakh 90? 11 lakh minus 1 lakh 10,000. Thus, the correct value of closing stock to be disclosed at 31st March 2006 would be lower of. The cost is 10 lakh or NRV, net realizable value is 9 lakh 90,000. Whichever is less, that is the value. So thus 9 lakh 90,000 being the lower of cost and NRV, the stock should be valued at 9 lakh 90,000 as per AS2. That's all. This is the completion of problem number 7. Now, problem number 8. Preksha Limited manufactures widgets. Widgets are devices, mechanical devices, whose cost details are as under. Rupees in thousands. Raw material consumed 2,000, direct labor 1,250, variable production overhead 750, fixed production overhead 1,450, including 5 lakh rupees towards interest. During the year, the company manufactured 550 widgets. It is a policy of valuing finished goods at a standard cost of rupees 10,000 per widget. Compute the cost of one widget for the purpose of closing stock. The company is operating at 100% of normal capacity. The company is having a policy of calculating the closing stock at a standard cost. The standard cost is 10,000 rupees per widget. 10,000 rupees per widget. Now remember what is the provision in AS2. AS2 says a company can adopt a standard cost only if it is unable or only if it is the company cannot be able to find out the actual cost according to absorption costing. Then only they can go for standard cost. If the actual cost according to absorption costing can be ascertained, in that case it is not allowed to follow standard cost. Now in our problem, specifically the data is given to calculate the cost per unit according to absorption costing. What is absorption costing? Absorption costing is a costing in which the total cost should be taken, including the fixed overheads. That means variable overheads as well as fixed overheads. All overheads are taken together. That costing is called absorption costing. So in our excluding interest charges. Remember, interest charges are not production cost. It is a financial cost. So excluding interest charges, we include all fixed overhead, variable overhead, labor, material, all these costs we include to calculate the absorption cost. Now see carefully, as per AS2, the finished goods of the stock of finished goods should be valued on the basis of absorption costing. Simply remember, absorption costing is a method in which we include the fixed overhead also. but it does not include interest charges because that is not the production cost. In absorption costing, fixed overheads are also apportioned based on normal capacity production. However, interest expense are not included in the cost of inventory, I told you, because these are financial expenses. Thus, cost per widget is as follows. Rupees in thousands, 3 zeros are omitted. So after omitting 3 zeros, material 2000. Actually, it is not 2000. 2000, these 3 zeros if we include, it will become 20 lakh. The material cost is 20 lakhs. We have removed the 3 zeros and made 2000. Labor is 1250. Actually, it is not 1250. 12,50,000. We have removed 3 zeros. Then variable production overhead 750. 7,50,000. And fixed production overhead is given 1450. 1450 is given in the problem. Meaning of 1450? 14,50,000. But 14,50,000 includes interest charges of 5 lakh. Remove 5 lakh. So 1450 minus 5 lakh, you will get 9,50,000. 9,50,000. Remove 3 zeros, 950. So total cost will be 4950. 49,50,000. That is the total cost of making how many widgets? 550 widgets given in the problem. So cost per widget is 49,50,000 divided by 550. You will get 9,000 rupees. So this 9,000 rupees is the cost per widget according to absorption costing method. The company is following standard cost method. The company is not following this absorption costing. The company is following standard cost method. But what the AS2 says? AS2 says we should not adopt standard costing if we can be able to find out the cost by absorption costing. So here AS2 allows standard cost basis provided it is difficult to calculate cost on absorption costing basis. Only when it is difficult to calculate the cost according to absorption costing, then only AS2 has allowed the business to follow standard costing. In the present case, the cost can easily be calculated as per absorption costing method and the cost per widget comes to 9,000 rupees. Here we have calculated. In the present case, the company can easily calculate the cost per widget and we got the cost per widget 9,000. Now AS2 says the company should not follow standard cost. The company must follow absorption cost. Now therefore standard cost method is not allowed. The absorption costing method is allowed. Hence the cost of 1 unit of widget for the purpose of closing stock is 9,000. So for the purpose of calculating the value of the closing stock, the cost per widget should be taken as 9,000. The company is not allowed to follow standard cost and value at 10,000. Not allowed. Only at 9,000 the company can adopt. So totally 8 problems I have completed on this accounting standard and all these 8 problems are on AS2, valuation of inventories. In the next video, I will start the next problem on other accounting standard like accounting standard 3, that is cash flow statement. So keep watching till the end. Don't skip in between to get the complete command. Remember, these accounting standard videos are very, very important not only for BCom students but also for other courses, PG students, MCom, MBA and professional courses for CA as well as CMA. So watch till the end with full interest, get a good command on the subject of accounting standard. Inshallah, we'll continue the next problem in the next video.